Paycheck Protection Program Interim Final Rule. This is an item that had been uploaded today, so I thought it might be worth looking into. This is at the U.S. U.S. Department of the Treasury website. We'll have a link to this below so you can see that we looked at these documentations earlier in a prior presentation. This item down here now is a new item that's been posted, the Paycheck Protection Interim Program Interim Final Ruling. They do lay some things out here a little bit more clearly. I'm going to be comparing this to the application. So these two items are the things I'm going to be comparing here, the application and then this new item, the Paycheck Protection Program Interim Final Rule. Here's the document in a PDF type format. I'm going to jump down to the thing that's most concerning or looks different to me that I want to point out, and then I'll go over some of the items that just jump out to me. This will recap a lot of the law, so I won't go in through the whole thing here. The first item is in section 2E, that's what do borrowers need to know? And then down here on number E, so 2E, how do I calculate the maximum amount I can borrow? So the following methodology, which is one of the methodologies contained in the Act, will most useful for many applicants. Step 1, aggregate payroll costs defined in detail below in F from last 12 months of employees whose principal place of residence is in the United States. So notice what it says there. It says the last 12 months. Now, if we're taking that, and I might be missing something here, but if we're taking that from, today, that would include 2020. You would think maybe that includes the first quarter of 2020. So if I was to read this kind of alone, then, and I just took that component, I would think, maybe that means the last 3 quarters of 2019, and then the first quarter of 2020. However, if I jump back over here to the application, it says for purposes of calculating average monthly payroll, most applicants will use the average monthly payroll for 2019. So if I read this, of course, I would think that 2019 would be what we would be using, and not the last 12 months, which would include 2020. So maybe I'm missing kind of the start date in the law, because it makes more sense to me to be using 2019 numbers, because it would just be easier to know. You're more likely to have it. That last quarter just ended, so you probably have the 940s and 941s if you're processing the payroll. But if you think about some situations such as a sole proprietorship, that they wouldn't, that there is based on self-employment income, they wouldn't really have it because they haven't done the tax return. So it would make sense to me more that it would be easier to do with the 2019 numbers. But just reading that one portion looks like it could include 2020. So what I would do, if you're going to try to process this thing through and you're getting ready to process through, I would make sure, to have the documentation they need. And if you have all the 2019 payroll stuff, then I would put together 2020 stuff just in case someone, maybe one of the loan departments is reading it, and maybe they're misreading it, and they want that number too for 2020 in order to process the loan. So you might want to just have the payroll ready for the first quarter of 2020, just in case, and maybe even do the calculations both ways, 2019, 2020, and give them, whatever you want, whatever they want. Just scrolling through this, there's some other components that just kind of jumped out to me that I decided to highlight, that I'll just go through as we go. So you must also submit such documentation as is necessary to establish eligibility, such as payroll processor records, payroll tax filings, and Form 1099 miscellaneous or income and expenses for the sole proprietor. So remember, obviously, you've got the payroll information. How can you support this? You're going to be needing to give the payroll information. If you're a sole proprietor, then you're gonna need to be given that 1099 information, and basically the expense information. You're going to want to, in essence, have your tax return as well, because that's going to be the calculation of the net income, which I would assume for the Schedule C they would be using there. Then I think it might be worth just going over the calculation again over here. So how do I calculate the maximum amount that can be borrowed? The following methodology, which is one of the methodologies contained in the Act, will be the most useful for many applicants. 1, aggregate payroll costs from last 12 months for employees whose principal place of residence is the United States. 2, subtract any compensation paid to an employee in excess of an annual salary of $100,000 and or any amounts paid to an independent contractor or sole proprietor in excess of the $100,000. So there's a $100,000 cap, so you got to take all the payroll, all the people that earn money, And then if someone earned over 100,000, like 120,000 or something, you assume they earned 100,000. If you're a sole proprietor and you're talking about Schedule C net income on which you're paying self-employment tax, which is, I think, the reason that might be something that would be included as basically payroll items, then same kind of applies. If it goes over the 100,000, then again, cap at the 100. That's how I would interpret that. Number 3, calculate average monthly payroll costs. Divide the amount from step 2 by 12. So you've got the annualized number for 12 months. Now you're going to divide it by 12, get the monthly number. Step 4, multiply the average monthly payroll costs from step 3 by 2.5. So you're just going to take that number times 2.5. And then step 5, add the outstanding amount of the economic injury disaster loan. So if you have an EIDL, so that was the previous loan, then you can add the outstanding balance made between January 31st and 2020 and April 3rd, 2020, less the amount of any advance under the EIDL COVID-19 loan, because it does not have to be repaid. So the advance portion, that up to the 10,000 isn't included here because it's not going to be a part of the loan that basically amount that's basically you would think would be kind of consolidated here. Now note that number 4, if I jump back over to the application, also says that, so we have that calculation, you could see that calculation on the form. So it's 2.5 plus the EIDL net of the advance. And then number 4 down here also says, has the applicant received an SBA economic injury disaster loan between January 31st and April 3rd? If yes, provide details on a separate sheet identified on the addendum. So it's also given the information related to that loan is what they're requesting here on line 4. So it's still a little confusing to me how exactly those two loans are gonna tie together at the end of the day. But in any case, let's go look at some examples. Maybe that'll clear some things up. The examples below illustrate the methodology. Example 1, no employees make more than 100,000. So we don't have to deal with that limit. Annual payroll is 120. So however many employees we have, we add them all up and it adds up to annual payroll for a 12-month time period, 120. Average monthly payroll, then, if you divide that by 12, is 10,000. Multiply that times the 2.5, there's the 25,000. That's what you have. So that's their easiest example. Example 2, some employees make more than 100,000. So now you've got the annual pay 1,500,000. So you take all the employees and all their wages, included those that make over 100,000, is 1,500,000. Then you're going to subtract compensation amounts in excess of an annual salary of 100,000. So you take all those people that made more than 100,000, you cap them at 100,000, and you subtract all the excess wages. The way you probably do this in practice is just make a spreadsheet and then cap everybody off at 100,000. So you say, if they make more than 100,000, cap it at 100,000, and then you'd add up everything, and everybody that made more would be at 100,000. All right, so that's going to be, they say that's going to be the 1,200,000. Average monthly qualified is going to be the 100. Multiplying that times 2.5 is the 250,000. Maximum loan 250. Number 3, no employees make more than 100,000. Outstanding EIDL loan of 10,000. So outstanding loan, this is the outstanding balance, which I think, the way I'm interpreting it, not including the advance if there was an advance payment, because it doesn't need to be repaid. That's the way I'm saying that. So then we'd say the annual payroll is 120,000, average monthly payroll 10,000. So that, because we divided by 12, multiply times the 2.5, 25,000. Here's the new thing. We're going to be adding the EIDL loan of the 10,000, getting up to that 35,000 here. So let's move on to item F down below. It says what qualifies as payroll costs. So that's going to be one of the key components. What is in payroll costs? So payroll costs consists of compensation to employees whose principal place of residence is the United States in the form of salary, wages, commissions, or similar compensation, cash, tips, or equivalent based on employer records of past tips or the absence of such records, a reasonable good faith employer estimate of such tips, payment for vacation, parental, family, medical, or sick leave, allowance for separation or dismissal, payment for the provision of employee benefits consisting of group health care coverage, including insurance premiums and retirement, payment of state, local, assessed on compensation of employees, and for an independent contractor or sole proprietor, wage, commission, income, or net earnings from self-employment or similar compensation. So that again puts the sole proprietor in there, who basically counts themselves as income. They pay self-employment tax. It's kind of like payroll taxes. So you would think that would be them there. They talk to this contractor issue in a little bit more specific of a way down below as well, which I think is a new thing. So we'll see that in a second. So G, is there anything that is exclusively excluded from the definition of payroll costs? Yes. The Act expressly excludes the following: any compensation of an employee whose principal place of residence is outside the United States, the compensation of individual employee in excess of an annual salary of $100,000, so there's that $100,000 cap, federal employment taxes exposed or withheld between February 15th, 2020 and June 30th, 2020, including the employee's employer share of FICA and railroad retirement tax and income taxes required to be withheld from employees, and qualified sick and family leave wages for which a credit is allowed under Section 7001 and 7003 of the Families First Coronavirus Response Act. Do independent contractors count as employees for purposes of the PPP loan? Now, this is a common kind of question. What if I'm a contractor and I don't hire people as W-2 wages? I hire them as contractors and I simply pay them, and then I pay them a 1099 wages. Well, this kind of makes sense to me, although it could be a problem for contractors. They say, well, no, because they're a contractor, right? It's not payroll. And again, I think that the key term here is that they're going to say, it basically comes down to when they're thinking of payroll, and it doesn't say this in the like my, interpretation of it, but if you're paying payroll taxes on it in some way, shape, or form, meaning Social Security and Medicare, I think that's kind of what they mean by the actual payroll. Because if you look at the different entities, that'll basically hold true. So if you're talking about an independent contractor, their wages, their net income, they're paying Social Security, Medicare on, and that would be their wages. The wages they pay to their contractors they're not paying Social Security on that. The contractors are, but they're paying Social Security and Medicare on their Schedule C, not as W-2 wages. And so that's why they would then, the contractors themselves would be the ones that would then try to apply for it. And the people that hired the contractors, that paid the contractors, don't count them as employees, but rather an expense, and the net income after that is what could, depending on what their status is and their payroll is. I mean, if they're a sole proprietor, then, and if they pay self-employment tax, then they would have their net income. So in any case, the money that you pay to the contractor isn't going to be payroll, because it's not W-2 wages. But it could still qualify, but not to the one paying it, but to the contractor. So it says no independent contractors have the ability to apply for the PPP loan on their own, so they do not count for purposes of borrowing the PPP loan calculation. What is the interest rate on the PPP loan? The interest rate will be 100 basis points or 1%. And just note, is the PPP first come, first serve? Yes. So there's a limited amount out there. So there's probably going to be a bit of a, scramble as they first kind of get this thing going. So you probably want to be, prepared and process all this stuff. Then can my PPP loan be forgiven in whole or in part? And we're going to say yes, and that's going to be the key component. So you want it to be forgiven. Or you're hoping that you can, forgive a component of it. So yes, the amount of loan forgiveness can be up to full principal amount of the loan and any accrued interest. That is, the borrower will not be responsible for any loan payment if the borrower uses the loan proceeds for the forgivable purposes described below and employee and compensation levels are maintained. The actual amount of loan forgiveness will depend in part on the total amount of payroll costs, payments of interest on mortgage obligations incurred before February 15th, 2020, rent payments on leases dated before February 15, 2020, and utility payments under service agreements dated before February 15, 2020, over the 8-week period following the date of the loan. So you got the date of the loan, then you got the 8-week period. After that, you want to make sure that you're spending your money in accordance with these rules for that 8-week period, so that you would then qualify for the forgiveness. However, not more than 25% of the loan forgiveness amount may be attributable to the non-payroll costs. So they want the principal portion to be going to the payroll costs. So I don't interpret that to mean that if you don't have exactly 25%, that you just drop off, it'll go all out. I think what's going to happen is that whatever the forgiveness is, they're going to calculate that 25% of it must be for the payroll. So if your ratio is over 25% to something other than payroll, then you're going to be limited. I would think the way this is reading would be it doesn't mean that you just drop off the cliff thing and you don't get any forgiveness. I would think that it would mean that they're going to take the 25% amount and extrapolate up, and that'll be kind of the cap calculation of it. 25% of the total will be the cap, and that could be less than the total amount that was actually spent. But that's my interpretation there. It wouldn't make sense to me that if it was 25% less than 75% to payroll, that it would drop off completely. It seems like it would phase out some way. But in any case, so then moving on to item P down here, do independent contractors count as employees for purposes of the PPP loan forgiveness? And so pretty much the same question, some principles involved here. So the independent contractors, do they count if I pay the independent contractors? Now we're not talking about for the qualification of the loan, but for the forgiveness, same principles, apply. So you get the same, result. No independent contractors have the ability to apply for a PP loan on their own, so they do not count for purposes of borrower's PP loan forgiveness. Q, what forms do I need and how do I submit an application? The applications submit SBA form 2483. That's the Paycheck Protection Program application, a payroll documentation as described above. So you want the paperwork for the payroll documentation. The lender must submit SBA form 2484 Paycheck Protection Program lender's application for 7A loan electronically in accordance with program requirements, and maintain the forms and supporting documentation in its files. So those are the items that kind of jumped out to me in this kind of last minute document before the start dates happen here. So that's you can, and again, we'll give the links so you can take a look at those yourself. So that's it.